Welcome to The Explainer. Today, we're diving into what feels like a trader's secret weapon. It's a systematic way to figure out exactly where the market might just decide to turn on a dime.
For anyone in the markets, this is the big one, right? The million-dollar question. And look, crystal balls are out, but there's a skill that gets pretty darn close, and that skill is anticipation. We're not talking about guessing here. This is about knowing exactly what to look for.
So the whole idea we're digging into today, it completely flips the script. Instead of just reacting to whatever the market throws at you, you're going to learn how to spot these key zones, we'll call them points of interest, that can actually help you predict the next move.
Okay, so what is a point of interest, or POI for short? Well, think of it like a hotspot on the chart. It's a very specific, well-defined area where there's a super high chance the market's going to make a sharp turn. That is our target. So how do we find them? Let's get into it.
All right, here's our game plan. We'll cover what POIs are, the three big keys to reversals, these patterns called PD arrays, and how time and price levels play together. Then we'll blend it all and give you a clear path forward. Let's go.
Okay, diving right in. The three keys to market reversals. This is the framework for figuring out what's coming next.
So you can really think of this as a three-part puzzle. You've got the what, the when, and the where. The what is all about specific price patterns. We'll call them PD arrays. The when deals with timing using something called time cycles. And the where? Well, that's about spotting key levels on the chart. Let's kick things off with the what and get into these patterns.
All right, let's talk price patterns, these PD arrays. They're basically the market's own sign language, these little stories that price tells. So a bullish breaker. This pattern is a huge, flashing sign that the market could be ready to flip from down to up. It shows up right after a high gets taken out.
Okay, picture this. The market's moving down, then it pops up a bit, and then it makes one last dive lower. But then, and this is the crucial part, bam, price explodes higher, breaking above that previous high. Now that little down move right before the big explosion, that is our breaker. It's like the market is showing its cards.
And this is where it gets really clever. The whole point of this move is to trap people. Just as the source says, sellers are getting lured in, thinking prices are about to tank. It's a total fake-out. The pattern tricks sellers into jumping in at the absolute worst moment, right before the smart money comes in and buys everything up.
Okay, but a pattern by itself isn't the whole story. Now we need to add the other two layers, time and price, the when and the where. And this is a really important point. Time cycles, they're dynamic. They're based on session highs and lows, which change every single day. But key levels, those are fixed. They're calculated from bigger price swings, and they don't move. So you've got these moving targets and these static, concrete levels. So what's the deal with time cycles? Well, it's all about engineering liquidity. What you'll see a lot is the market will open, push just a little bit past yesterday's high or low, and then whoosh, it reverses hard. It's a classic purge and revert. It's like it's cleaning out all the stops before it makes its real move.
All right, now for the really cool part. This is where we put all the pieces together. Blending these elements is what gives you that precision. It's the real aha moment of this whole model.
So, you've got your price patterns. They tell you what to look for. Then you have time cycles. They tell you when to look. And finally, the key levels. They tell you where to look.
And that's why this quote is so perfect. It's time then price. You see, time without the right price level, it's kind of useless. And a price level without the right timing, also useless. But when you get them to line up, that is when you can really start to anticipate. The best setups, the A+ ones, happen when all three of these things overlap. The right pattern, at the right time, at the right price level. That's the magic formula.
So what's next? Well, here's your path to making this your own. It's time to put this knowledge into practice. And look, the source gives you literal homework. Your mission is to go find 15 examples where price reacts to one of these POIs. Really focus on how those three pillars, the pattern, the time, the level, are all involved. Look for that sharp, undeniable rejection away from the level. Remember, this isn't about just reading theory. It's about getting your hands dirty and training your eyes to see this stuff live.
Which leaves us with this final thought. Now that you have this framework, the what, the when, and the where, can you actually start to see the market's next move before it happens? Think about it. The goal shifts from just reacting to truly anticipating, and that, my friends, changes the entire game.